I will teach you to be rich. Chapter 1: A Rich Life. What does it mean to have a rich life? Maybe it means living in a swanky apartment in Manhattan. Or perhaps it means picking your kids up from school every day and having a big yard for them to play in. A rich life is ultimately about freedom, the freedom to do the things that are important to you. And money can often play an important role in helping to acquire that freedom. There are two main schools of thought on how to attain this money. The first teaches you to save every penny until you're old. Once you hit 80, you're rich. The second suggests that you spend most of your free time researching stock tips and the crypto markets, always looking for the next big trade. But Ramit Sethi, a personal finance advisor, believes there is a better way, one that doesn't require dubious market bets, constant skimping, or extensive time. In his best-selling book, I Will Teach You to Be Rich, Sethi shares the smarter approach, distilling financial advice into simple, effective strategies. Sethi was inspired to learn about personal finance after losing scholarship money in the stock market as a teenager. By the time he graduated from Stanford, he had already begun his now famous blog, iwillteachyoutaberic.com, which has helped millions to be smarter with their money. For Sethi, a rich life isn't reached after decades of sacrifice and deprivation. Instead, he believes it should be lived in the here and now. A rich life is based on certain key principles. Here are a few of them. Get started. Some people think they have to do everything at once. They get overwhelmed and never start. So start small. Try applying one chapter of this guide per week. Mistakes, don't worry about them. Better to make them now, while you have less money. Focus on big wins. A big win is an action or decision that makes an outsized impact on your financial life. Negotiating for a higher salary is a good example of this. When you focus on big wins, day-to-day purchases will become less consequential, and therefore less worrisome. Spend big on what you love, spend little on what you don't. This approach feels less restrictive than cutting expenses across the board. Investing should be boring. A simple buy and hold strategy may not sound exciting, but it's the most effective way to grow your money. Live life. Once you set up and automate your financial plan, if you spend more than an hour a week on your finances, you're not doing it right. Act, don't react. Too often, we wait until the end of the month to look at our spending. But by this point, it's too late to change course. We pay punishing fees without question, and without a plan for avoiding them in the future. Instead, be aggressive with your finances. Examine, make a plan, and then act. The following chapters are full of practical advice and strategies inspired by these principles. So read on. But remember to act on what you read, one strategy at a time. Your rich life awaits. The main ideas. Chapter 1. A rich life, a life of freedom and growing prosperity, is achievable by following certain principles and strategies. Focus on big wins, actions with an outsized impact on your finances, instead of worrying about minor purchases. A simple buy and hold strategy is the most effective way to grow your money. Chapter 2. Take control of your credit. When we make our largest purchases, houses, cars, we almost always do so on credit. When you buy something on credit, you borrow the money up front and promise to pay it back later, usually with added interest. Lenders use your credit score, along with your age and salary, to set the interest rate of your loans. Lower interest rates can result in potentially hundreds of thousands of dollars in savings over your lifetime. So, improving your credit score is a big win. The easiest way to improve your credit score is by using credit cards responsibly. Let's go over some rules for how to do this. Rule number 1. Always pay your bills on time. Your payment history represents 35% of your credit score. Even one late payment can lower it by over 100 points. In addition, you'll get charged a late fee. The interest rate on your card may shoot up, and the rates on your other cards might increase as well. All this means you're paying more. Now, if this does happen, don't stress out. Keep up with your payments, and your credit score will probably bounce back after a few months. Rule number 2. Keep your cards for a long time. The more history you have with your credit cards, the more it helps your credit score. Just make sure to keep your cards active, otherwise, they could get canceled, and that could end up hurting your credit score. Rule number 3. If you have no debt, ask for a credit increase on your cards. This will lower your credit utilization rate, the amount that you owe divided by your available credit. Your credit utilization rate comprises 30% of your credit score, so its impact is significant. Sethi does this every 6 to 12 months. Just remember to only do this after you've paid off all your debt. Credit cards have other uses as well. First off, they make it easy to track your purchases. That's a big plus. And credit cards can function as free short-term loans. If you buy a gift for $100 with your card, then pay your bill in full 3 weeks later, you've essentially borrowed $100 for 3 weeks, interest-free. They can also double the length of any warranties upon purchase for almost anything you buy with your card. They can even provide free car rental insurance. Some credit cards also offer benefits in terms of cashback or travel rewards. These cards give you a percentage back from every purchase, either in cash or frequent flyer miles. However, the good rewards cards have fees, so only get them if you charge thousands of dollars per month. That way, the rewards will be worth more than the fees. To choose a card, Sethi recommends going to a site like bankrate.com, where you can easily compare different cards. You'll find better deals here than you will in the mail. And definitely, under no circumstances, should you sign up for a retail store credit card. They have high fees, crazy high interest rates, and underwhelming rewards. Finally, don't get too many credit cards. 2 to 3 cards is the sweet spot. Keep it simple. The main ideas. Chapter 2. Use credit cards to build your credit score, and for the many other conveniences they offer. By paying your bills on time and occasionally asking for a credit increase, you can improve your credit score. A key benefit of credit cards is that they allow you to easily track your spending. Chapter 3. Beat the banks. When Sethi thinks of a typical American bank, he thinks of Wells Fargo, one of the 4 largest banks in the U.S. In the 2010s, Wells Fargo opened unauthorized accounts for 3.5 million of its customers. These accounts triggered millions in fees and damaged many people's credit scores. Sethi says, big banks are trying to screw you for all the money they can get out of you. You see, most people open one bank account and then remain customers for years, decades even. The banks count on customers being too lazy to switch, since there is a certain amount of work involved in changing banks. Don't be that lazy person. There are some good banks, but you have to know what to look for and what to avoid. Let's focus first on some common marketing tactics that banks use to screw you out of your money. Teaser rates. This is when they offer a short-term special interest rate on new savings accounts. Example, 6% for the first 3 months. Don't fall for it. Minimum balances for free checking. If they say the no minimum, no fee accounts aren't available anymore, insist upon it, you'll likely get it. If not, move on. Upsells to fee-based accounts full of worthless features. You don't need to pay extra for things you'll rarely use, such as expedited customer service. Credit cards bundled with your bank account. Even if you need another card, it's doubtful that the one they offer has optimal rates, terms, and benefits. Okay, so what positive things should we be looking for? Trust. Ask your friends which bank they love, then look at the bank's website. The good banks don't have a multitude of fees and are upfront in their descriptions. Convenience. Can you do most of your banking through their website? Is the website easy to use? Can you reach a live agent when necessary? Features. Good banks don't charge a fee every time you transfer money. You'll also want a competitive interest rate for any savings accounts you open. Just don't be obsessive about finding the highest rate. Assuming you found a good bank or two, it's time to set up and optimize your accounts, both checking and savings. Your checking account is where your direct deposit goes and where you keep your immediate spending money. A savings account is for your longer-term goals, such as a trip to Europe or your wedding. Now for a little surprise, it is best if these accounts are at different banks. Why? Because you want to make it difficult to drain your savings account. It can take up to 3 days to transfer money between banks. Use that to your advantage. Another way to optimize your accounts is to avoid fees at all costs. One of the main culprits is overdraft fees. As a precaution, keep a cushion of money in your checking account. Sethi suggests keeping at least $1,000 in there, if you can. And remember, with banks, almost all fees are negotiable. If you get blindsided by a fee, call the bank up, tell them it was a one-time mistake, and ask them to waive it. Many times they will. Using strategies like these, you can make the banks work for you, not against you. The main ideas. Chapter 3. With the right knowledge and strategies, you can get the best out of your banks. Look for banks that offer forthright descriptions of their services and not too many fees. To optimize your bank accounts, use 2 different banks to protect your savings, cushion your checking account, and ask for fees to be waived. Chapter 4. Invest the right way. The single most important thing you can do to increase your wealth is to invest in the stock market. But there's a catch. If you try to outperform the market, you will likely lose. Even hedge fund managers, people who employ the best PhDs that money can buy, only beat the markets 10% of the time. Instead, your goal should be to match market returns. And you can do that by investing in equity, stock, index funds, These low-fee funds are set up to mimic the market. The stock market increases 8% per year, on average. That's a healthy return, and miles ahead of even the best savings accounts. Let's compare. If you put $10,000 in a savings account that earns 2%, you'll have $18,000 after 30 years. Put that same $10,000 into the stock market, and after 30 years of growth at an average rate of 8% per year, you'll end up with over $100,000. Is the stock market risky? Yes, it is. But every market downturn and crash in history has been followed by a period of even greater growth. The key then is to invest long-term. If you're in your 30s or older, you might want to add bond index funds to the mix. These are lower risk, lower return, and help balance your portfolio. But the easiest and best thing to do is this: invest in target funds. Target funds are targeted at a certain retirement date. They have names like Target 2040 or Retirement 2050. Based on that retirement date, they choose the best mix of equity and bond index funds. As Sethi explains, target funds are easy, low cost, and they simply work. There are two types of retirement accounts that will supercharge your investment returns: 401(k)s and Roth IRAs. A 401(k) plan allows you to invest your money pre-tax. It's taken directly out of your paycheck. In fact, this money will never be taxed until you pull it out at retirement. These tax-free gains, which build upon themselves year after year, can greatly boost your overall returns even after taxes are finally imposed. And we haven't even gotten to the best part. Many employers will match what you put in, up to a certain level per year. This is basically free money. Your 401(k) investment options will be funds ranging from conservative to aggressive. Choose aggressive unless you're getting close to retirement. There isn't an easier way to grow your money. If your company offers a 401(k) plan, many do. Talk to HR to set it up. And if not, there's always the Roth IRA. When you invest money through a Roth IRA, the investment gains will never be taxed. This is so powerful. There are, however, annual contribution limits. And if your salary is too high, it won't be an option for you. You'll have to set this up yourself through a brokerage. According to Sethi, Vanguard, Schwab, and Fidelity are the best ones. Once you have the account set up, choose a target fund as your investment vehicle. Then start contributing a little money every month and watch it grow. The main ideas, Chapter 4. Investing through target funds and retirement accounts is the best way to grow your money. With 401(k) accounts, you can invest your pre-taxed earnings. Investment gains from Roth IRAs will never be taxed. Chapter 5. Conscious spending. Almost every book on personal finance recommends that you create a budget, a detailed spending plan that requires you to track every penny. Though most people believe they should have a budget, few are able to actually stick to one for more than a month or two. And yet you can't control your financial life if you don't control your spending. So Sethi devised a conscious spending plan to counteract what he saw as the two biggest weaknesses of budgets: deprivation and effort. First, you divide your financial life into 4 buckets: fixed costs, long-term investments, savings, and guilt-free spending money. Fixed costs, things like rent, groceries, and insurance, should represent 50 to 60% of your take-home pay. Next up are your long-term investments, such as your 401(k) and Roth IRA. You should aim to spend 10% of your take-home pay on this. Another 10% should go to savings. This is for things like holiday gifts or a down payment on a house. The remaining 20 to 30% of your take-home pay is yours to spend however you like. With a traditional budget, you would try to squeeze your discretionary spending into this 20 to 30% by cutting a little bit of everything. Cheaper clothes, cheaper restaurants, cheaper apartments. The overall effect is a feeling of deprivation. Sethi believes you'd be much happier by choosing the things you love enough to spend extravagantly on, and then cutting costs mercilessly on the things you don't love. For example, maybe going out at night with your friends is really important to you, so spend big in this area. On the other hand, maybe expensive clothes and frequent travel aren't as much of a priority for you, so drastically cut back these categories. When you allow yourself to spend a lot on your biggest passions, it makes it much easier to control spending in other areas. The other big problem with budgeting is keeping track of every single purchase, no matter how small. But with conscious spending, you focus only on the big categories. You don't have to budget for the occasional latte, because purchases like these are small in comparison. Sethi also offers some additional strategies that can help you control spending. First off, set realistic goals. If you're spending $500 per month on eating out and decide to bring it down to $300 per month, don't do it all at once. It'll backfire. Instead, decrease your restaurant spending by $25 to $50 per month. That way, you're much more likely to stick to it. You should also try the a la carte method. Go through your subscriptions, websites, movies, gyms, and cancel the ones you don't use a lot. When you want to go to the gym, just buy a day pass. Or for movies, spend $3.99 for the occasional rental. Simply by being aware of each purchase when you make it, your spending will naturally start to go down. The envelope system is another great tool. Assign an imaginary envelope for each category, like restaurants or buying shoes. When the money in your restaurant's envelope runs out, you're done with eating out for the month. Or you can dip into your shoes envelope to pay for an extra night out if you feel it's worth the trade-off. Each of these strategies will end up making your conscious spending plan both easier and more effective. The main ideas, Chapter 5. Conscious spending allows you to control your spending while still enjoying the things you love. Spending big on what you love and cutting mercilessly on what you don't helps to avoid feelings of deprivation. To help control spending, set realistic goals, and use the a la carte method and envelope system. Chapter 6. Save while you're sleeping. Now we're going to automate our conscious spending plan from the last chapter. Automation frees up your time and it makes investing and saving a default, not a monthly choice. So how exactly do we set this up? Accounts need to be linked before money can be transferred between them. When you log into these accounts, look for options such as link account, transfer, or set up payments. For any bills that can't be paid by credit card, like your rent, log into the company's website and link your checking account to it. Or you can use your bank's bill pay feature, where the bank sends the check for you. It's almost always a free service. Next, go into your credit card accounts and link them to your checking account. Once everything is linked, you can set up the amounts and dates of the transfers. You'll want to make sure you synchronize your bills and transfers. This will make it much easier to keep track of what you're spending and how much is left over. Schedule your bills and subscriptions to coincide with your direct deposit. These should all be paid automatically with your credit card. To change the billing dates, just call the companies. It should only take 5 minutes per call. Then set up your credit card bill to be paid from checking a few days after this. This is also a good time to schedule any transfers to your savings and investment accounts. Anything that's left in checking after this is yours to spend. It's worth noting that freelancers and others with an irregular income can still apply the strategies from this book. The trick is to save a lot during the good months until you've built up a significant buffer. Once this cushion is in place, you can then simulate a stable income by paying yourself from the buffer when a slow month comes around. It's also worth mentioning that it'll take time to implement the strategies in this book. Sethi suggests at least 6 weeks, but the payoff is worth it. In 5 months, or 5 years, when you're distracted by other things, your system will still be there working for you. It'll grow with you, easily accommodating any salary changes over the years. And by taking much of the uncertainty out of your buying decisions, you will be able to step back and be less emotional about your spending habits. Instead of worrying over every single purchase, you'll be able to focus more on the long term and chart your financial future.